Hi, everyone. As we predicted in 2021, yesterday, on the 26th of January, 2022, the Fed turned full-scale hawkish, and it signaled that they will end bond buying as early as March. Powell warned that inflation is now above 2% with greater upside risk. This is what he said. He said, I think there's quite a bit of room to raise interest rates without threatening the labor market. So he's going all for it without talking about the labor market right now. Previously, he was talking about the labor market improving first before they did something. Now the whole stance has changed. They also said that they will look to reduce the balance sheet of $9 trillion. But as we expected, they did not mention when they're going to do this. This is what Powell said. With inflation well above 2% and a strong labor market, the committee expects it will soon be appropriate to raise the target range for the federal funds rate. Now, the January 2023 Fed funds futures contract is pricing in 5 rate hikes in 2022. Banks like BNP are already looking at 6 rate hikes. Yellen herself, between 2013 and 2018, I'm using this example, she raised rates a total of 5 times when she was Fed chairman. And she unwound the stimulus that Ben Bernanke implemented. So this is not something impossible. They can raise rates 5 times. They have done it already before. Okay. So at the back of this news last night, the dollar index surged to 96.85 against major currencies. And we expect the dollar index, as we have been saying in 2021, it will go higher. And we also said that those countries that don't keep up with the Fed and raise interest rates, their currencies will suffer the most. And we saw this happening this afternoon, especially with the Malaysian ringgit. So how do we make money from a Fed taper like this? Yesterday, when Powell started talking in this mode, in this hawkish mode, the stock market went down. All the stocks gone down. Dow Jones, NASDAQ, S&P. But again, I'll repeat this. Our mantra is simple. As long as you buy quality names and companies with low or no debt, strong balance sheets, a pipeline of goods and services that are in demand, when there is no Fed stimulus, something else kicks in. You have no punch bowl. You have no free money coming out. Okay? So what does a company depend on? It goes back to depending on earnings and the balance sheet. If you buy good companies that report healthy earnings despite the interest rate environment, you will not go wrong. Okay, so we go back to the drawing board now. And for 2022, we focus on companies with strong balance sheets. Like I said, and I say again, it is not going to be a broad-based market, because when you buy a stock, it doesn't mean every stock will go up or every stock will go down. In this choppy market, volatile market, as you have seen for the last 2 weeks, which we predicted again that the market would fall in January, it is still good to buy companies with healthy balance sheets. And believe me, these companies will go up. And with this tapering 5 or 6 interest rate hikes in 2022, the US dollar has the most potential to rise against currencies that have low beta, such as the Japanese yen, the euro, and the Swiss franc. This afternoon during London session, the US against the Japanese yen, the US dollar against the Japanese yen rose to 115. And the US against Japanese yen has now outperformed all the G10 currencies. Our algo is bullish on the dollar as the market further prices in the more aggressive and Fed and hence additional monetary policy divergence. As US interest rates go up, those currencies that do not raise interest rates or those who do not raise interest rates fast enough, the gap between US interest rates and the interest rates of other countries will widen. People will start buying US dollars to earn higher interest rates. And like I said, this afternoon, we saw the Malaysian ringgit also falling against the US dollar. In fact, most Asian currencies fell against the US dollar. Now, in the midst of all this one direction mode, dollar going up, stocks going down, there is one spark of hope, what we call one small caveat emptor. I want you to listen to this. I'm giving you an opposite theory now. The reason we have high inflation is because due to COVID. And COVID caused the supply chain to erode. Okay? And this drove the prices of goods and services up. Okay? But the thing is this, recently even Janet Yellen said that once the pandemic is controlled, inflation would start dropping in the later part of 2022. In fact, at one stage in the press conference yesterday, Powell did say he does see inflation dropping in the later part of the year. Even BlackRock sees the Fed hitting the brakes. This is why. Last night, Powell used the 2015 example as a reference for rate hikes. That's very concerning to BlackRock because 2015 was a recovery in the demand-driven environment. Now it's not a demand-driven environment. Now it's a restart in a supply-driven environment. Okay, so BlackRock says Fed is signaling an intent to ease off the gas but not hit the brakes, meaning there is a possibility if we see interest rates dropping in the later part of this year, you could see the Fed not even hiking four times. You could see the Fed hiking only 1 or 2 times because when they see inflation dropping, there's no real need for the Fed to hike so aggressively. So there is still a possibility here, a caveat emptor here, but it all depends on data coming in. It all depends on how much inflation goes up from here. We are living in exciting times. There are interesting opportunities. And like I said, and I will say again, volatility is your friend. Do not be afraid of volatility. Volatility helps us create new wealth. With that, I'll leave you. And if you have any questions, please contact me at ashwin@ppchk.net or at bit.ly/algotrader on WhatsApp or bit.ly/algofactory on Telegram. And you can also go to YouTube and watch our videos on bit.ly/algowealth. Thank you so much.